Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.
All right, let's talk a little bit here about the outlook for equities, particularly as a lot of people look at this bull market and wonder whether it can continue into 2025. Price targets are coming in for the new year, and we should point out price targets for the past year, well, they were light. John Stoltzfus, though, he was always bullish, and he had a good eye on what he saw and what he thought we would get in 2024. And now he's out with his note for 2025, saying that the bull market has more room to run, writing that the pivot to easier monetary policy, we believe, supports our view that the market for U.S. equities is still mid-cycle. And he says that the technology-led double-digit gains of the large-cap stocks over the first 3 quarters of 2024 likely to broaden out to other sectors, styles, and market caps in 2025. Pleased to say that John joins us right now here on the big program, kicking us off here on this December 31st. Happy New Year to you, John. And let's talk about those forecasts going forward. What supports some of these targets? I'm seeing targets come in now, including yours, into the 6s, into the 7,000s for the S&P 500. Is this all earnings driven, or are we going to see some multiple expansion as a part of that as well?
Raymond, great to be on surveillance this morning with you, and Happy New Year to you and the whole Bloomberg team as well. I must say that with us, it's a combination. It's always, you want to see revenue growth, you want to see earnings growth. That's what matters most to the market. But I think overall, there's room for multiple expansion to play a role in here. The private investor over the years, I've been in this business for 41 years, has changed a lot over the years, and with the what has taken effect in terms of retirement planning over the course of the last 40 years, in which we've seen defined benefit pension plans go by the wayside, Social Security, the amount of income that it can provide, or what percentage it provides an individual of income during retirement, means people have to invest more. So we think many private investors today, instead of investing in 5 stocks for the actionable idea of the day, are investing much like institutions would for intermediate to longer term goals. And we think that supports higher multiples, while on the other hand, we think the effects of technology on all 11 sectors that has been shown since the financial crisis right up to date through the pandemic, and now with AI in the process, offers a lot of opportunity here to see equities move higher.
We'll expand a little bit here on that theme of AI. That was a big part of the trade that we saw in the market, certainly in the first half of the year. A lot of questions, though, towards the second half of the year about when we start to see the material gains from that on the bottom line and on the top line, for that matter, as well. We see that in 2025, John?
Yeah, I think we'll begin to see it more and more. I think this year it's been primarily the amount of investment that has been made in AI, both from within the technology sector itself, but in the other sectors by managements that want to remain very vibrant and effective in attracting investors' attention in terms of creating greater efficiencies for revenue and earnings growth. And on the other hand, we think it's the consumer is going to be a big part of the upgrade that began in this year and likely will gain some traction in 2025 and on forward. But all this stuff takes a bit of time. But for investors, you know, who have patience, are diversified, know what they own, why they own it, and have right-sized expectations about how different asset classes, different sectors, cyclicals versus defensive, et cetera, operate. This looks like a time of both opportunity and risk. And the main thing is to have some tolerance for fluctuation and a tolerance for risk that is realistic and right-sized.
John, how much of the bull case is dependent on capital flows from the rest of the world? In the absence of kind of economic resilience in Europe or China, do you see international investors bolstering the U.S. market, maybe more so than domestic?
Gosh, that's an awfully good question. I think over the years we've seen private investors from abroad increase their exposure to the U.S. A lot of that because of the influence of the technology sector with the innovation that occurs here in the design stage of technology. But in addition to that, the factor is in an uncertain world, the U.S. strength of the U.S. dollar also attracts foreign investors to invest in the U.S. While meantime, central banks and sovereign wealth funds may actually stay at home, many of those foreign funds. We think it's the individuals will continue to invest for diversification in the U.S.
But John, you mentioned that point of the dollar, that it attracts international investors. Doesn't it disincentivize that bid? So an investor in, say, Japan, hypothetically, that maybe wanted that realm of safety or kind of innovative technological exposure, maybe looks at the strength of the dollar and in 3 months' time and says, actually, this isn't worth it?
Well, actually, we would have to say that the strength of the dollar is relative. And I think with the dollar's strength where it is right now, for instance, it almost disincentivizes U.S. investors from investing abroad because the foreign currencies are weaker versus the U.S. dollar. On the other hand, for foreign investors where their currency is weak versus the U.S., investment in the U.S. enhances dividends, enhances gains. Because investing in a stronger currency helps your performance if you're a foreign investor with a weaker currency when you reconcile your trades, or you don't get a loss in translation, but a gaining in translation.
I am curious, John, here, if you can talk a little bit here about how some of the policy decisions that we're expecting out of Washington could affect the performance of financial markets. And I want to start specifically on the tariff side, because there are some concerns about the bottom line effects on corporations and obviously the inflationary effects on consumers.
I'd have to say, Romaine, that the greatest concern relating to tariffs, of course, is on the traditional sense of tariffs. Everybody can remember tariffs presaging the Great Depression and all. But the effect of tariffs during the first Trump administration and during the Biden administration, when he actually kept many of the Trump tariffs and even increased them, was not anywhere near as of concern as might have been expected. We think the idea of some of the numbers that are thrown around by the president-elect in terms of what he might impose on tariffs, much of this we would think is part of that art of the deal approach that the president-elect takes when negotiating. But the other side of it is, if you consider the U.S. economy versus producing economies of all the goods that our consumers buy, both businesses, consumers, as well as individuals, we're buyers of size. And so we're a very attractive place to sell your goods to, which might mean there's more wiggle room for countries that want to sell into our country or export goods to us to win our import dollars, so to speak. And we think it'll be interesting to see how that works out. But we think most of the talk on the tariffs, based on the cabinet and the experience of the cabinet, as well as the president's experience after having had 4 years in office prior to this, we think it'll be more of the bark will be louder and much more create more fear than the actual bite. And we also think the negotiations will probably work out better because countries are going to look to want to keep the U.S. as a major source of their exports.
John, great stuff as always insightful all year long, and we expect that as well in 2025. Have a happy new year. John Stoltzfus there over at Oppenheimer, a Bloomberg survey showing that right now the median price target right now for the S&P to end next year right around 6,600. The highest estimate in that survey came from the man we were just talking to, 7,100. Creedy, we talk about this idea here of whether expectations heading into 2025 are going to match up in the same way that we saw with those low to high expectations in 2024. We do want to turn our attention right now to the commodity space and specifically energy. Oil markets, well, they're pushing higher here in the last trading session of the year. This after we got a report that factory activity in China did expand for a third straight month. Pavel Molchanov over at Raymond James, he's looking ahead to next year. He says that, well, they're forecasting oil prices to be largely range-bound. However, the main energy story of 2025, which was also the main story of 2024, is set to be electricity rather than oil. Pavel joins us right now to talk a little bit more about that. And Pavel, let's talk about it here. I mean, if you had told me coming into this year that some of the biggest gains in the equity market would be utility and power companies, I would have said you're crazy. But here we are at the end of 2024 talking about utilities and power companies. That continues to be the story next year?
Yeah, and this is the derivative trade on AI. So the euphoria around AI touches what we might call the picks and shovels of the electric power industry. So the utility stocks, the equipment providers, so everything from gas turbines, wind turbines, solar panels, battery systems, and also the construction companies that are physically building all of this energy infrastructure to accommodate the boom in electric power consumption.
When we talk about the building of this infrastructure, and you have obviously new infrastructure coming on here in the U.S., you have old infrastructure, old nuclear plants coming back online here. Is there enough out there, I guess, if you will, for these companies to draw on, or are we going to be facing significant shortages in power given some of the demand needs out there that we know of, at least when it comes to computing and AI?
Well, our listeners do not need to worry about, physically running out of electricity, at any point in the foreseeable future. That's not going to happen. What is true is that power prices are already trending up. In fact, they've been up since pre-COVID by about 25%, and we should expect power prices to continue moving higher, in part because of the additional demand from the data center build-out. And look, let's also keep in mind the geographic differences here. The bulk of the data center, or the largest portion of the data center build-out, is happening around Washington, D.C., Northern Virginia, Maryland, a little bit into Ohio. There is not as much happening in the western half of the U.S. There's also, by the way, data center build-out, AI-related in Europe, in parts of China. So this is a global story. But Northern Virginia has the largest portion. So naturally, that's where the infrastructure needs to move forward at the fastest pace.
Pavel, when I first learned about how utility grids worked, I was pretty surprised to learn that you can use both oil and natural gas, and sometimes natural gas can be cheaper in utility grids as well. There's a big conversation in the U.S. right now about exporting a lot of extra natural gas and LNG to Europe. But if you see this AI data center build out in the U.S., do those flows get redirected?
Natural gas going to Europe will be limited not so much by the ability of American gas producers to pump as much as they want, but rather by Europe's need to import LNG. And here's why I say that. since Russia invaded Ukraine 3 years ago, Europe's consumption of natural gas is down by 15%. I'm not talking about down 15% from Russia. I mean, that's practically at zero. But overall, Europe is using 15% less natural gas. So guess what? That means less need for natural gas from any source, U.S., Qatar, Norway, and Azerbaijan, and so forth. So that's really where the constraint is going to come from.
So there's no necessarily relationship between the natural gas needs of Europe or the natural gas needs of other folks in the United States versus, say, the AI build-out?
We have plenty of natural gas in North America to do both. So natural gas will certainly play a role, particularly in the eastern half of the U.S., to support the data center boom. Now, in the western half of the country, as I said, AI is less of a factor. But keep in mind, we also need to replace coal plants that are being retired. And this is why we're going to be following an all-of-the-above strategy for the electricity mix. Natural gas, wind, solar, and in certain cases, and with also long lead times, nuclear as well.
I am curious, though, Pavel, do you think that, at least here in the U.S., that government policies coming out of this new administration will be supportive of some of those renewable energy initiatives like wind, solar, nuclear, et cetera?
Number one thing we need to understand about government policy as it relates to electric power is that it is predominantly at the state level rather than the federal level. Electric utilities are regulated by state-level utility commissions. There is a little bit of a role played by FERC and the Department of Energy in Washington, but number one is the state-level regulation. So here's an interesting fact for some of your listeners. 29 states have a renewable portfolio mandate for electric utilities, including, by the way, some red states like Texas, Missouri, and Montana.
Yeah, and it'll be interesting to see whether that holds and how that interplay between those states and the federal government goes forward. I do want to ask you a much more straightforward question about the oil market and particularly about the mobility of oil. Obviously, there are a lot of concerns about geopolitical issues and the disruption of flows of oil. You have the wars obviously going on in the Middle East and elsewhere that have also disrupted the flow of oil. Do you see any sort of right-sizing in that next year, or are these sort of, issues that are going to just remain lingering for a good portion of the year?
For the past 12 months, we have had two major wars, Russia-Ukraine, and of course what's happening in the Middle East. Despite that, oil prices have barely moved since January 2024. Why? Because we also have to take into account what's going on with demand. And demand has been weaker than expected, in large part because of China. So number one question for next year is not so much geopolitics. It's good old-fashioned supply and demand. What's going on in China with the economy? And by the way, with electric vehicle sales, half of China's auto sales are now electric. That's a big deal. We're also watching the dollar, strengthening dollar, as we have seen pressures commodity prices across the board, including oil. And the third thing we're watching is OPEC. OPEC has been very disciplined since COVID with supply. At some point in 2025, OPEC will begin to unwind its production cuts, which means more barrels on the market. And that may put some pressure on the price of oil as well.
All right. Pavel, great stuff. Pavel Molchanov over at Raymond James. A closer look here at the energy market, the outlook for 2025. We begin this hour, though, with equity futures sitting on modest gains. Stocks hoping to snap a three-day losing streak here on the final trading day of 2024. The S&P having a wonderful year, a blistering year. The index up about 24%. Matt Miskin of John Hancock seeing a limit, though, to further gains, writing that it's going to be hard for equities to stomach much more upside. While we still prefer U.S. equities based on the better fundamentals, we recognize the magnitude of outperformance in 2024 is not likely to be replicated. Matt joins us right now to talk a little bit more about that outlook. And Matt, maybe we don't see the same gains we saw in 2023 and in 2024, but should we expect at least some meaningful gains in 2025?
It's certainly possible, Romaine, but what we're seeing here is heavy is the crown, really, for U.S. equity leadership and U.S. economic leadership, frankly. After certain stints like this, where U.S. economy has just blown past most global economies, the U.S. dollar has strengthened a lot. So it's up about 6% in 2024. A stronger dollar makes us less competitive on a global basis. It helps actually bring down inflation because we're buying stuff from abroad. But it is difficult to stomach for economic purposes. Then rates have been higher. So we have high-quality bond yields, 10-year yields higher on the year. That's a bit of a slowdown. And then there's massive expectations out of the U.S. economy and markets into 2025. So the earnings estimates for 2025 for the S&P 500 are still about 15%. So there's a lot of optimism. One of the biggest assets the S&P 500 and U.S. large cap stocks have had over the last several years has been conservative and more kind of bearish sentiment. Mm-hmm. The sentiment dial has been turned up significantly to end 2024. We think that's becoming a bit of a liability as we walk into next year.
Well, that's what I am confused about here. We talk about how crowded some of these trades are. We talk about the lack of hedging that we're seeing in the equity space, and the idea that you have valuations, at least for some of these companies, at least by historical standards, would be stretched. I know there are some people that want to reinterpret history, but what do you do in that situation? Do you reallocate? Do you stand by your conviction that maybe some of those stocks can go higher? What?
Yeah, momentum is not a fundamental factor, and momentum was the number one way to outperform, the only way to outperform, frankly, in 2024. So what is momentum? It means you look at the best performing stocks over the last 6 to 12 months, and you allocate the most to those. So basically, chasing performance was rewarded in 2024. But to your point, Romaine, there's other things that drive stock markets, whether it's valuations, whether it's earnings. And those parts of the market have been left behind this year. And there's a bit of a dogs of the Dow type formula where usually the worst performers can sometimes become the best performers in the subsequent year. This year, ending this year, the dogs of the Dow kind of mantra looks more realistic as a potential turnaround or catalyst into 2025 because we are so stretched on the valuations. We're at about 22 times on 4 PE on the S&P 500, the highest in history, at least the last 30 years has been 24. There's about 9% upside we can get on valuations. Earnings estimates are already great. Dividend yields are the lowest in history. So to your point, it's hard to eke out gains in the more expensive stuff. The better value stuff could come around. Sorry.
Why do you believe that in the essence of when you see sell-offs happening, you're seeing a lot of babies thrown out with the bathwater here? And if you believe that maybe some of these underperformers can come back next year, how much of a risk is there that just risk appetite alone goes along with it?
Yeah, that's the tide that lifts all boats and the risk appetite. But what we're seeing, look, is into next year, there's just hard to get more valuation upside on the other parts. It's not necessarily calling that they're bad companies, that they're going to see this, really bad performance. It's more just saying the multiples can expand in more like mid-cap stocks and small-cap stocks versus large-cap stocks. Internationally also has been really a tough performance year. European equities are only up about 2% in U.S. dollar basis. They're very cheap still. So what we could see is just a rotation or even, I would say, downside protection because the valuations are so much more attractive. So those are the types. We're just trying to manage risk the best we can. And frankly, the high flyers don't look good to us because of the valuations. And part of the value space that's deep value, the earnings aren't as good. We're trying to apply quality at a reasonable price as our mantra into 2025.
So then is the best way to hedge the equity market, in essence, the equity market? Because if you're looking at the volatility in the bond market, is that really a place to go hide?
We think it will be into 2025. Inflation is likely to come down. Inflation is the nemesis of that bond market inverse correlation really that hasn't been around for the last year or two. But inflation has come back a bit to end the year. We think that's more sentiment driven. We do think that comes back down into 2025. And really, it goes back to housing. I mean, we're going to get some housing price data today. We're really dialed into mortgage apps, housing price data. Housing made up about 60 to 70% of the inflation narrative over the last several years. If that can slow down into 2025, inflation comes down, bonds act like bonds again. And if that happens, a balanced portfolio really can look much better from a diversification benefit standpoint into next year.
Matt, I want to go back to something you just said. It kind of startled me. One of the great things about having a Bloomberg terminal in front of me is I can kind of check everything on the fly. About dogs of the Dow. They were dogs all year long here. I mean, I was just taking a look at the dogs coming into this year. We're talking about underperformance by about, 25 percentage points relative to the S&P 500, just to use that as a comparison. And I'm looking at some of the ones that will probably be the dogs going into next year. I guess the ones with the highest dividend yields, like Verizon, Chevron, Amgen, and Johnson & Johnson, to say the least. I mean, some of these names were the same dogs coming into this year, and I am curious as to whether this is also about sentiment and attention. If all the attention is on tech and AI and other things, like, why should I expect anyone to really embrace a healthcare stock or even just a consumer staple stock or a telecom stock?
Yeah, so momentum, like I said, was the best performer, and all the other factors did not work. So you had to chase performance. If this is not a year of a rotation, it's got to be the 1990s all over again. So there's only been 3 other times where there's been 25% back-to-back gains like we're looking at here potentially. The only time it went 3 years in a row was in 1999. So we're going to have to kind of bring out the popcorn, watch maybe some Jurassic Park or Friends, or we're going to have to get our 90s culture back. But 1999, you got to be careful what you wish for, because if we do get that third year where it's just another momentum year, it's going to be tough, because then you got to be careful what you wish for, because then we got the lost decade after that. So we would start to peel back that momentum trade and rotate into higher quality but value parts of the market.
I mean, one thing, though, too, about the comparison with the 90s, and a lot of people will make this comparison, which is the idea that in the 90s you were dealing with a lot of companies that just did not necessarily have the fundamentals to support those valuations. We talk about a market, and I checked it this morning, 70% of the gains, the point gains in the S&P 500, attributed pretty much now to about 9 stocks, basically the Mag 7 and a couple on top of that. But all of these are names that are just cash monsters: NVIDIA, Apple, Amazon, Broadcom, Meta, Tesla, Microsoft, Alphabet, JP Morgan, Netflix. Those are winners, man.
I agree. No, we've been overweight tech. We've got that, but it's just hard to see the same kind of return stream that we've gotten out of them into next year. You know, you can only do outsized return. There is reversion to the mean over time, usually with markets, and we are in the most concentrated market in history by a huge factor. So 40% of the market is just in those top 10 stocks. And I'm talking about the S&P 500. That's never happened before. It's never even been close to this high before. So reversion to the mean would suggest that at some point those trillion-dollar mega cap companies have already built in the valuation to those great cash flows. I'm not saying, look, we've got it in the portfolio. We've got a bit of an overweight relative to other parts of the market. Yeah. But going into next year, chasing that doesn't make a lot of sense to us. Finding other opportunities across the portfolio, other asset classes, makes more sense in our view.
Matt Miskin over at John Hancock. Happy New Year to you. We'll catch up with you in 2025.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.